Hey guys, what's going on? In this week's webinar, we're going to talk about cross-currency analysis. This is important in my opinion because we have to know which asset we want to trade. Sometimes an asset class can be high resistance, which means it moves with struggle. So it's not moving to targets easily. Often you see the price action is not clean, a lot of choppy price action. So that's where cross-currency analysis comes in. Um, so yeah, we're gonna talk about that a little bit. We're gonna obviously use Euro USD, GBP USD, Euro GBP, and the DXY because that's a really nice combination to use when you're doing cross-currency analysis. And honestly, those are the only asset classes you need to focus on if you're still learning. You can do it with a lot more. For instance, you could use Euro GBP with GBP JPY, Euro JPY, and then the JPY index, but that's something else. We're going to focus on those four instruments right now. How can we frame intraday setups using this cross-currency analysis? Also very important to know because you want to be in the one that moves the cleanest, right? And with the most force. So we'll show some examples later. So yeah, let's go to the next slide. I have a little cheat sheet over here, created myself. Basically, we've got DXY on the left. So we always use the DXY as the main mover. So we first determine where does DXY wants to go, and then we're going to base off our analysis on which of the two we want to trade. So do we want to trade Euro USD or do we want to trade GBP USD, right? So I've got some scenarios outlined over here. If DXY moves bullish, then X. If DXY moves bearish, if DXY is consolidating, etc. Let's start with the first one. If DXY is moving up, we are expecting all foreign currencies to go down, right? We are expecting Euro USD to go down and GBP USD to go down. Now, sometimes you can see GBP USD move harder than Euro USD, and that's where the analysis of Euro GBP comes into play. So this is then the cross-currency analysis. So we're expecting the dollar to go higher, foreign currencies to go lower, but which of the two are we gonna trade, right? Then this comes into play, Euro GBP. We're gonna do an analysis of which way or which direction is most highly likely to trade in. So DXY wants to go up. Maybe Euro GBP is in a deep discount, so we're expecting Euro GBP to go up. Now, what happens when Euro GBP goes up? Right? The euro has more strength over the pound. So if we're expecting Euro USD to go down and GBP USD to go down, but the euro is stronger than the pound, we want to avoid Euro USD, selling Euro USD. Why is that? Because euro is stronger than the pound, so you might see some lower or slower movement down on Euro USD or even consolidating. More likely is that it will follow down too, but with less force than GBP USD. So we determine GBP is the weakest at that moment in time. So it should be low resistance cells for GBP USD. So in short, if DXY goes up, dollar is strong. If Euro GBP goes up, the pound is weak or the euro is strong, right? So we're going to couple up the weakest with the strongest. So we take the weakest one, which is the pound, and then we pick GBP USD to trade. Same occasion if we are expecting it to go down. If the DXY goes down, we're expecting Euro USD and GBP USD to go up. Now, if Euro GBP is consolidating, you can pick either, because if it's consolidating, it's relatively equal in strength, right? So it doesn't really matter if you take Euro USD or GBP USD. But if you're expecting Euro GBP to go up, we're obviously going to go with Euro USD, right? Because Euro has more strength. DXY is going down, so dollar is weak. The strongest one out of the three. Dollar weak, Euro strongest. then we go, oh, it's going to the next slide already. So yeah, dollar down, euro the strongest, and then we're gonna go with euro USD. I've added this one on the bottom because I forgot to put it in, but yeah, you get the gist. You can actually use this if you're trading. I use it. Obviously, I don't have to have the cheat sheet next to me because I know which how it should move. For instance, even if you see, if you just look at Euro USD and GBP USD, and you see GBP USD go down and Euro USD go slowly up, you can already know Euro GBP is going up, even without looking at that pair. So use this, make a screenshot of it. This is pretty handy. I will post it in the Discord too. So yeah, now let's look at some examples. We have the dollar index daily chart. This is all very recent. I like to do the webinar with recent price action so we can gauge what could happen next potentially. So looking at this daily chart, right? We came off this high over here. Oops, don't click it. So we came off this high over here, right? Now we're seeing it trade lower, breaking this structure over here. This is a breaker. So we're breaking down over here and we're having trouble to move up. So we're trading sideways in this area. So what happens when DXY trades sideways, right? Euro USD trades sideways, GBP USD should trade sideways. But what if GBP USD trades up higher? What is going to happen, right? Then we go to the next chart, which is Euro GBP. You can actually see Euro GBP is in a downtrend. As I also outlined in the market outlook from last week, right? We're only expecting sell side to be provided for Euro GBP. You can see this massive sell off over here, which was logical, right? Because we have this low here and we have this low here. So this is low resistance liquidity, which we're going to talk about in a bit too. So this was an easy target. In the start of the week, we were up here. We're respecting bearish PD arrays, right? So it was highly likely to go down. Now what happens when Euro GBP goes down? The euro is weak, the pound gains strength. So now we're gonna expect when DXY trades sideways, it's better to buy GBP USD because Euro USD is most likely to trade sideways. So let's head over to Euro USD. You can see same as the DXY, right? We're trading sideways. Still respecting this little daily fair value gap up here, or down here rather. So we're still expecting it to move up, right? Because we're respecting bullish PD arrays at the moment, and we are disrespecting the bearish one, which is this bearish order block. And we have some easy liquidity up here, which should be low resistance. But yeah, using Euro GBP right now with DXY sideways, Euro GBP down. That's why the euro is not willing to go higher. And now if we go to GBP USD, look what happens on GBP USD, right? This whole area up until this point was a consolidation on Euro USD. Now, Euro GBP going down just makes it a lot easier for GBP USD to go up. And that's again because of the weaker euro and the stronger pound, right? So that's how you can gauge which one you want to buy or sell, right? So we're expecting Euro GBP to go down, so we're instantly not ever gonna look for Euro USD buys because euro is weaker than the pound, and we're only gonna look for buys on the GBP USD. Now I've outlined some analysis on Euro USD this week, expecting it to trade higher, which was logical because DXY is in a market maker sell model. But obviously, with Euro GBP going bearish, the safest bet was going with GBP USD buys, as you can see over here on this daily chart. Now let's go to a little bit more detailed chart. Right, so this is a 4-hour chart on the DXY, right? So outlining that market maker sell model, right? So we have the buy side of the curve over here, smart money reversal. There was a daily swing high over here, which got rated, and then we're breaking structure after that rate of the high. very important. If the high didn't get rated and it breaks down, it's just going to discount to move up again. So that's something you can put in your notes. Very important to note. We need to rate some sort of liquidity before breaking down, which makes it higher probable to go on the sell side of the curve. We have this small original consolidation down here with equal lows, right? So we already see a target down here, buy side of the curve, heading into the sell side of the curve. Now we have this massive consolidation, right? Now this is the point where Euro USD was consolidating to, and with Euro GBP being bearish, it's very tough for the Euro to go up. So big consolidation, hard to trade in. But again, looking at all the PD arrays, right, which are getting respected, we have this order block here with a fair value gap, which got tapped a lot of times. So this is a pretty tough price action to maneuver yourself in. But nonetheless, knowing that on which side of the curve we are on, we know which way DXY should trade, which is lower. Going to the British pound, we can actually see a lot more clean price action, right? So we are first at the sell side of the curve, right, which was logical because DXY went up. And then when DXY started to trade higher or lower, you can see GBP USD trade up with more ease. We're breaking structure over here, obviously, dipping back into that fair value gap, which also has a breaker over here. I did not outline it, but this is a breaker, this bullish candle. Because why? We took sell side liquidity here, and then we broke structure after. So this bullish candle is a breaker. It's overlapping with a fair value gap, which is getting respected. Price dipped one more time, a little bit deeper into the daily order block to grab the last orders and started to push up. Oh, my bad. So now let's go to the next one. So Euro USD. This is the same time where the fair value gap was as GBP USD. So look at this one, and I'll scroll back one more time. Right, so the daily fair value gap got hit on GBP USD. Going back to Euro USD, this is the same time area over here as GBP USD, but look where Euro USD is, right? It's not even close to the same area where GBP USD is right now. And this is all has everything to do with the Euro GBP analysis. It was in premium, it's on the sell side of the curve, right? So yeah, Euro USD stays stuck in a consolidation. And right now, that's why GBP USD is the better buy. And you can actually see this is the Euro GBP chart on the 4-hour. We have short-term sell side of the curve because we're breaking structure to the downside. Trading in the buy side of the curve, right? So at this moment in time, this buy side, it's better to not buy GBP USD. And why is that? Again, euro stronger, right? At this moment in time, pound weaker. So we want to avoid buying GBP USD and rather sell it, right? Because a weaker pound, and if the DXY goes bullish at the same time, it's very easy for GBP USD to go down. Now, going back into the sell side of the curve, this is from this week, sell side of the curve, right? So we're expecting a weaker euro and a stronger pound. So DXY going down, euro GBP going down. So the best focus is buying GBP USD. So compare all those four instruments with each other. Determine where is the discount and the premium of that specific instrument, right? So potentially next week we could see a little short-term buy side back into the breaker block, which is unmitigated yet. We have got some buy stops over here. We're breaking a short-term high, and we rated sell side liquidity, so there's some potential to go back into the buy side of the curve. Now, what does that mean? We're still expecting DXY to go down a little bit more, right? And when Euro GBP goes up, what are we going to focus on? Euro USD buys instead of GBP USD buys, right? So that makes sense. Let's couple them up all together so we can get like an overview of what happened, right? So on the top left we have the dollar index. Top right we have Euro GBP. On on the left on the downside is Euro USD, and on the right on the downside is GBP USD. So now you can see clearly if you have those all together, looking at them, right? We're expecting DXY to go down. We're expecting Euro GBP to go down, right? At this moment in time over here. At this moment in time over here. What happens to Euro USD, right? Stays in a consolidation. Now look, we have this DXY breaking the to the downside, right? The sell side liquidity has been grabbed. But what happens over here? It did not even go to the same highs as the lows on DXY, right? So we have some SMT going on right now, which I will cover SMT in another topic, in another video. But right now we can clearly see DXY wants to break down further, and Euro GBP, Euro USD has some trouble going up, right? And that has all to do with the Euro GBP analysis, which was bearish, and then you can clearly see the euro having no strength, and the pound is stronger, and you can see it all cleared into the daily fair value gap. And yes, this is what I love to do. I like to do the cross currency analysis to pick which instrument I should trade. So let's go to the next slide. We're going to talk about high resistance liquidity runs and low resistance liquidity runs too. I wanted to include that in the video because some of you guys asked for it, so I thought just let's combine this video with that. Right, so let's go to this one. What is a high resistance liquidity run, right? It already says, kind of says what it is, right? It has trouble to go and run more liquidity at one side of the curve. So looking at this chart, it's a New Zealand dollar, US dollar chart. With high resistance liquidity runs, I like to say it's against order flow. Every run on every low against order flow is a high resistance liquidity run. We have this long-term low down here, right? We're breaking structure here. We've created a short-term low here. You can see it runs the buy side instantly. That's easy. So it has low resistance going up. So this one you could see already. Then we're trading lower, and then rating this low, right? And then instantly moving up. So this is a high resistance liquidity run. There's a lot of resistance down here to go further down, right? And every time it runs a high, it has no problem doing that. So high resistance liquidity run, moving up, very low resistance, and every time it creates a short-term low over here, it runs it and then instantly smashes up, right? So this high resistance liquidity run, because there's a lot of liquidity protecting the lows, right? So say you want to sell over here, how likely is it to go over here, right? It has to go through this low over here. It has to go to a fair value gap. It has to go to an order block, another low, and then you'll reach this area over here. So there's a lot of resistance down here, and that's a high resistance liquidity run. There's too much it has to go through before it reaches its target. So stick with the order flow, right? And then you'll see every run on the short-term low and then creates displacement after. That run on the low is a high resistance liquidity run. You can see the same over here. We have obvious buy stops up here, right? It creates a short-term low here, runs up. Buy stops are still intact, right? Then it runs that low and you see it trades up instantly. High resistance liquidity run. Same thing over here. Creates a short-term low, runs up easy above these highs. So easy liquidity up here. Retraces back. Does a high resistance liquidity run here because it has no juice to go further, and it instantly runs up. Same case over here, again creating a short-term low around equilibrium of this range, runs it, and then instantly the force which it breaks through makes you have confirmation this is a high resistance liquidity run. So this is how I few high resistance liquidity runs. It has to go through a lot of resistance before it reaches a target, but instantly it rejects at those points. Now let's look at a low resistance, right? So how do we identify low resistance liquidity runs? It's where a price has no problem to go, right? And the word says this already, low resistance. What is low resistance? Equal lows, right? Fair value gaps. And if you're with the bearish order flow, you can see every rate on every high is a high resistance liquidity run, right? So we have this short-term high up here, gets rated, and then the force which it goes down, it has no problem taking out recent lows again, right? So we're in bearish order flow, we have the equal lows, we go into, this is a good area for liquidity, right? It cannot break this high, so we're creating another high. So right now when we break down, we have to go to 2 highs before we reach the target, right? And it has no problem running the lows. So we run the lows with force, and it retraces up back into that old high, old low. And it has no problem running the lows again, right? So that's how you see this is low resistance. It has no problem running it down again. Then we retrace up, taking out all those highs, which is high resistance still, because we're holding on with this order block here, and we have a fair value gap, right? And then it instantly takes out this low resistance, goes up, creates a short-term high, runs the low again easily, another short-term high, runs the low easily. So every time you see a low get rated easily or a high get rated easily, but the opposing order flow has no juice to go up, right? So this high created has no juice to go up anymore. So this is a high resistant liquidity run against order flow, right? Because we're definitely on the sell side here. So every low or equal lows are easy liquidity. I like to see big liquidity voids as low resistance too, because there's only sell side provided. And it has to be rebalanced and redelivered at some point. So when order flow suggests it's going towards that liquidity void or that big fair value gap, that will be your target for a low resistance liquidity run. So yeah, let's wrap it up over here. I hope this video is helpful to you. If you have questions, you can always send me a message or throw it into the group, right? I will always answer. So yeah, don't be shy and ask questions if you have some questions. Hope this was helpful, and we'll speak in the next educational video, guys.